Hello, good morning. It's Thursday the 16th. I'm FX Blue and this is the market brief. So it's a big day for the MPC today. They vote on whether they should hike interest rates to help curb inflation. That vote will be this morning. Yesterday, UK CPI inflation hit a 10-year high of 5.1%. And producer price index also hit new highs. That's the cost of goods at the factory gate and is a leading indicator for the path of consumer prices. That was up to 14.3% in November. Big moves. Following the last meeting, Governor Bailey said that he wanted to see the effect of ending furlough before considering a rate hike. And we've had rather encouraging employment data earlier this week, so it would seem that that condition has now been met. But we also have a rather rapid rise in the Omicron case numbers. There was a record number of new infections yesterday, close to 80,000 in a single day, and that has naturally put a rate hike in doubt. So what do you think? A vote for no change to see what happens with Omicron. That could easily see inflation over 6% by January. Perhaps not the end of the world, as it would just need a slightly more aggressive rate hike strategy to pull that back under control. Or do they hike today, as they would have done without Omicron? That would certainly help curb inflation, and they could always reverse the decision in January if it does look like we're moving into lockdown. In the market, sterling still looks priced for a no change outcome. Sterling also came under pressure from yesterday's Fed meeting, and we kick off this morning around 132.45 against the dollar. So yes, as expected, the Fed doubled the pace of withdrawal of economic support. As Powell said after a previous meeting, it's time for the Fed to put away the emergency tools. How very inspiring. In the press conference, Powell explained that a rate hike would be inappropriate while support is still being withdrawn. And that certainly leads into the Fed's methodical approach to tightening monetary policy. While the risk of Omicron continues to be a concern, the balance of risks with inflation and growth both still on the up now favours a tighter monetary policy in the US. So the plan is the additional pandemic support should be fully withdrawn by March next year. Then the first rate hike should come in around Q2, which will probably be 25 basis points. And then either one or two more rate hikes will follow before the end of 2022. Sounds like a pretty good plan, right? Well, the market certainly thought so. The dollar index rallied to a new high for the year. That touched 96.90 before a little correction brought it back below 96.50 again on the day. Euro dollar, meanwhile, sold down to below 112.40 yesterday, but recovered after the event, and we open around the 113 mark this morning. Right then, well, that's it from me. Fingers crossed for the rate decision. Hope it's not too choppy out there. But if it is, I hope it leads into the position that you want for your dollar exposure. Join me again tomorrow. All the best.
If you do not have a clue, then just tweet through and ask FX Blue.